All right, welcome back to the Financial Shepherd Happy Hour. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Wanted to welcome you all to 2023. Hopefully, I'm the last person to welcome you to the new year, and certainly hope everybody had a wonderful holiday season and a really good start to your New Year's resolutions. I know that we made ours, and we're very much looking forward to an outstanding year here in 2023. For those of you that may be watching the happy hour for the very first time, this is the first happy hour episode that we're dropping for 2023. I don't know about all you all, but after a long holiday season, a really fun and exciting way to start out the new year. Got to watch a lot of football, some of my favorite teams. And I honestly needed a little bit of break from having a happy hour. So I'm excited to be doing the first happy hour of the year here today. Cheers to everyone. Very excited about the start of the market this year, and looking forward to a little bit of relaxation for this weekend with a very big and important quarter coming up here in Q1, and of course the very beginning of tax season for 2023 for last year's taxes in 2022. So obviously last year, 2022 stock market was a very rough year. And for those who are watching the show for the first time, the reason why we do these little fun happy hour episodes on a Friday, obviously at 4 o'clock when the market closes, I think a lot of people are looking forward to relaxing a little bit. So grab your favorite beverage and just get a little summary of what happened this week in the markets, what was exciting, potentially what's coming around the corner here pretty soon, and ultimately what does history have to say about the start of the year that we've gotten off to so far this year, what it can mean for you and your portfolio throughout 2023. So I'm very excited, and an excellent start to the year here after a very, very difficult 2022. So to start off the year here this week anyway, just looking at a recap of this particular week, the S&P 500 was relatively flat. We had a holiday on Monday, of course, with Martin Luther King Day. Dow Jones Industrial Average, that was the best performing major indice last year, being down only about 8%, I believe. Whereas the S&P 500 in 2022 was off 20%. The NASDAQ, the tech sector, that was down almost 34% for 2022. And it's kind of reversing course here right now as we're talking. The Dow Jones Industrial Average for the week was down 2.2%. The NASDAQ tech sector positive 2%, best performing sector so far this year here in the United States. Energy still doing very strong, positive 1%. Big part of the energy play, by the way, for those who are catching the show for the first time, energy has been the only sector in 2022 that was positive, and it was positive in a very big way, about 50% positive when everything else was in the negative to some degree. And energy is still off to a pretty good start here with a strong week at positive 1%. International. So developed markets internationally up 1.61% for just the week. And the best performing asset class, if you look at all asset classes globally, is to start the year here with emerging markets. So not third world countries, but countries that maybe aren't completely developed, but are international companies. They're doing excellent for the week, positive 1.75%. So really good start for the overall markets, not just here in the United States, but also globally. For those who have been watching the show for a while, you would know that here at Shepherd Wealth Management, we believe in modern portfolio theory, which is just a concept that was developed back in the 50s, won an economic Nobel Prize by Harry Markowitz, still taught in every business school around the world today. And the reason for that is Mr. Markowitz was able to prove that by controlling your asset allocation, which is just a fancy way of saying this is how much of your money that's invested in stocks versus bonds and cash, then you can actually control about 94% of the variability of the performance in your account over whatever period of time you want to look at. So that's good news for the individual investor. Lots of things we cannot control, but one thing we can always control is our asset allocation. I remind you of all that because here at Shepherd Wealth Management, we customize portfolios for clients using that approach, and we were out of international all of last year. It finally started to recover in October, late October last year. Had a pretty good November, December. My major concern, like a lot of people, obviously the war is still going on over in Ukraine, which could, change directions at any point in time. Certainly hopeful for a peaceful resolution there. And the other big issue was whether or not China was going to come out of COVID zero policy. They are now, it looks like. So that definitely helped out the energy space as well as the international space. And let's just be honest, international had a recession last year for a lot of different reasons, including inflation, war, et cetera, supply chain issues. And they're starting to recover from that. And really, it's been about 15 years since the last time international has outperformed the US market. So it's a very wide gap. But hopefully international will perform very well this year. We're starting to recommend that for clients again and slowly starting to rebalance into that asset class. Same thing for fixed income. Fixed income rates are actually falling, which is a good thing for stocks, as we can tell here to start the year. A lot of it has to do with the anticipations of what the market believes the Fed's going to do with interest rates. Excuse me, I'll talk about that more here in just a second to wrap up our happy hour podcast. But rates coming down is certainly good for stocks, as we have seen here. And we just got started with earnings season. So we're about ready to get into what I would call the fun part of earnings season after the banks have already announced all their earnings. But so far, 53 companies in the S&P 500 have produced their earnings so far this quarter. 11% of the S&P 500 so far, so a lot more to come. But thus far, of the companies that have reported the earnings per share, about 4% median are beating estimates, and 64% of those reporting are beating earnings per share estimates, which is pretty good. On top line, so sales growth, about 2% median average beat for those that have reported so far, and 64% of those companies that have reported so far have beaten estimates for top line revenue. So certainly the major question is relating to the upcoming Fed announcement on February 1st. They're going to come out and talk about the economy and how much they're going to raise interest rates. I don't think anybody believes they will not raise rates, although the bond market, including myself, is looking at the actual data on the ground, and it's suggesting that they really don't need to raise rates at all. There's about a 75 basis point difference between where the Fed wants to take rates and where the 2-year Treasury, what the actual market thinks they're actually going to do with interest rates. So somebody's certainly right, and we're going to find out in real time exactly who that is here in the coming weeks. And then we'll certainly get another Fed announcement again in March as well. So I think that based on the actual data that we got from December, the PPI, Producer Price Index core, came in way lower than expectations. It came in at 0.1%. Economists were looking for 0.4%. If you take the 3-month annualized core PPI numbers that we've received in November, December, and now in January, that 3-month annualized is running at about 2.2%, which is pretty darn close to that 2% core PPI inflation that the Fed's striving to get to. So there's a real dynamic going on as we're talking here between what the Fed wants to take, where they want to take rates, at least where they think they want to take rates, and what the actual numbers are suggesting. And that's indicative of what the 2-year Treasury has been doing so far this year, which is simply coming down. So for those that are investing in fixed income, you're getting a really good, attractive rate on treasuries these days. The 6-month Treasury, last I saw, for rebalancing for clients was about 4.8%. 9-month Treasury around 4.7, and a 1-year at about 4.6, 4.7 as well. So not a bad, kind of guaranteed return over a very short window of time. But the farther out you go down that yield curve, the lower and lower the yields become, which becomes a little bit more unattractive because certainly we don't know exactly where rates might need to be, out into the future. So we've been kind of recommending keeping the duration, how long those fixed income maturity assets are going to mature. That's what duration means. How long am I going to get my principal back if I hold it all the way to maturity? And there's an inverse relationship between interest rates and fixed income. So if rates are going up, that's bad for the underlying price of fixed income. And as rates come down, that's a good thing for fixed income assets, even on the longer end of the curve. So we'll see how that all works out here into the markets, but certainly rates coming down is a bullish signal for stocks. A lot of people and analysts are calling for earnings to fall. Again, we have a lot more earnings to get to. 89% of the S&P, we still have not seen their earnings yet. But thus far, earnings have been holding up very nicely. That was been a big concern for a lot of individuals, analysts, and customers, is that earnings per share estimates for this coming year were going to be a little bit too high, and thus far that hasn't been the case. The other issue, certainly for concern of a lot of investors, is the inverted yield curve. and kind of how that has led historically to recessions. And I would actually argue that yes, that statement is correct. But I believe that we went through that recession in 2022, even though it wasn't officially called. We did have 2 consecutive quarters of negative GDP, and the market in the S&P 500 was down 20%. So that is classic textbook recessionary definition. One reason why the United States government didn't rubber stamp that with the word recession is because of the extremely low unemployment rate that we have in this country, and is still tracking at 3.5%. So truthfully, this is what a soft landing looks like. Earnings are holding up. Interest rates are coming down. Expectations for inflation are certainly falling and falling rapidly. And we'll see what the Fed wants to do about information. And of course, international markets and their Fed chair people are also stimulating their economies as well, not calling for recessions in this calendar year. So I believe the inverted yield curve and recession happened in 2022. And I think that we're about to see a recovery here for stocks, and specifically for the tech sector, again, being the worst sector of all 2022, and off to a very good start this year, along with international. So that's a pretty good summary of the week. We got a lot to look forward to, more earnings next week, and then a Fed announcement on February 1st. I would highly recommend continuing to tune into this show so we can provide you with weekly updates of what's going on in the market, what does history have to say about it, and then, of course, we'll do our bi-weekly podcast about 40 to 50 minutes long, giving you more details, more in-depth conversation and information about what's going on today. And again, more importantly, what does history have to say about it? Because the one thing that Warren Buffett has famously said over and over again is that human beings, we know for sure, have not learned from history. And he's 100% right. These economic events have a lot of cyclicality to it. They happen over and over again. And that's because we're all human beings. We're kind of hardwired with fear and greed emotions, and behavioral finance has taught us that we feel losses twice as much as we feel good about gains. So I want to prevent you from making that emotional knee-jerk reaction when really all this stuff that's happening in the market is very, very cyclical and has certainly happened. At least similar events have happened in the past. We can learn from that if you pay attention to it. And you can really put yourself in a nice position to benefit from the ultimate recovery likely that we'll see here in 2023. Obviously, past performance is no guarantee of future results for all the compliance people watching out there. Had to disclaim that, but again, there's a reason why the market tends to repeat itself over and over again, and we really need to learn from history to take advantage of that. So I love sharing this with you guys. I hope you guys have a great weekend. Catch us next Friday around the same time, 4 o'clock, 4:15 for a happy hour. We'll likely be posting a new podcast. We got a brand new president of Shepherd Wealth Management, John Ashcroft. You can go to shepherdwm.com. You can check out all of his background information as well as mine. And of course, if you're interested in checking out other YouTube videos, other happy hours, there's a link right on the top of the website that'll take you to YouTube as well as Spotify for audio recordings. You can enjoy that throughout your weekend and your week. Cheers. Hope you all have a great weekend, and go Bengals. Take care.